Let's begin by exploring the concept of agricultural income under the Indian Income Tax Act. Agricultural income is unique because it is exempt from central taxation as agriculture is a state subject. This means only state governments can tax such income. To qualify as agricultural income, three conditions must be met. The income must be derived from land, the land must be situated in India, and it must be used for agricultural purposes. This includes rent or revenue from land, income from cultivation, and income from farm buildings used for agricultural operations. For example, if a farmer earns money by selling crops grown on their land, that income is considered agricultural. However, if the land is used for non-agricultural activities such as running a dairy farm or brickmaking, the income is not classified as agricultural. Understanding these distinctions is crucial, as misclassification can lead to disputes between taxpayers and authorities. Now, let's look at the different kinds of agricultural income and how partly agricultural income is treated. Sometimes, income can be partly agricultural and partly non-agricultural. This happens when an activity involves both cultivation and further processing or manufacturing. For instance, a sugar mill that grows its own sugarcane earns agricultural income up to the point of harvesting, but income from processing sugarcane into sugar is considered business income. Similarly, tea gardens, rubber, and coffee plantations have rules to determine what portion of their income is agricultural and what is taxable as business income. The income tax rules provide specific percentages for such cases. For example, 60% of tea income is treated as agricultural while the rest is business income. This distinction ensures fair taxation and prevents misuse of exemption. Additionally, there are clear examples of what does not qualify as agricultural income, such as income from dairy farms, fisheries, or letting land for non-agricultural purposes. Understanding these nuances helps in accurate tax computation and compliance. Moving on, let's discuss casual income. Unlike agricultural income, casual income refers to earnings that are unexpected, non-recurring, and not derived from a regular source. Examples include lottery winnings, betting, crossword puzzles, and rewards received without prior agreement. Such income is taxable at a flat rate of 30%, and no deductions for expenses or losses are allowed. It's important to note that personal gifts, capital gains, or professional receipts are not considered casual income. The Income Tax Act is clear about what qualifies as casual income, ensuring that windfall gains are taxed appropriately. For instance, if someone wins a lottery or receives a reward for tracing a lost item without prior arrangement, that amount is taxed as casual income. This distinction helps maintain fairness in the tax system and prevents confusion between regular and irregular sources of income. Finally, let's clarify the difference between capital and revenue receipts, which is vital for both accounting and tax purposes. Capital receipts arise from transactions involving capital assets, such as the sale of property or compensation for loss of a source of income. These are generally not taxable, except for capital gains, which are taxed under special provisions. Revenue receipts, on the other hand, are routine earnings from business operations like sales or professional fees and are fully taxable. The distinction depends on the nature of the transaction, the intent of the parties, and how the receipt is treated in the hands of the receiver. For example, compensation for loss of future profits is a revenue receipt, while compensation for loss of a business source is a capital receipt. Understanding these principles helps ensure correct tax treatment and compliance with the law.